All right, let's talk about something that's really at the core of any business: revenue. We're going to break down IFRS 15, which is basically the global rulebook that tells companies how and, maybe more importantly, when they can actually count the money they've made.
So let's kick things off with a pretty simple question. When a company sells you something, they get your money. That seems straightforward, right? But from their side of the fence, when does that cash officially become revenue they can report? Well, the answer is a little more complicated, and honestly, a lot more interesting than you'd think.
So, why do we even need a big, complex rulebook for this? Because before IFRS 15, things were kind of messy. You had software companies, construction firms, retailers, all accounting for their sales in completely different ways. So, trying to compare their financial health, forget about it. It was a total apples to oranges situation. IFRS 15 was created to get everyone on the same page. To really get a handle on this, we're going to walk through the official 5-step model that's at the very heart of this standard. We'll start with just identifying a deal and follow it all the way through to when the company can actually book the revenue. It's a logical path, and by the end, it'll all click into place. But before we dive into those 5 steps, let's just zoom out and look at the big idea. The core principle of IFRS 15 is all about recognizing revenue to show the transfer of goods or services to a customer for the amount the company expects to get. It's all about matching the money you book to the promises you've delivered on. To make this all feel a little less abstract, we're going to follow one single, simple transaction all the way through. So imagine you walk into a store and buy a new smartphone bundle for $1,000, flat. For that price, you get 3 things: the phone itself, a 1-year warranty, and a 1-year subscription to a streaming service. Let's see how IFRS 15 picks this deal apart. Okay, step 1, first things first. We have to be sure we're actually looking at a real contract. Not every handshake deal counts in the world of accounting. There are some specific boxes you have to tick. So the standard basically has this checklist. Both sides have to be committed, what everyone gets has to be clear, payment terms I laid out, the deal has to have a real business purpose, and crucially, the company has to be pretty darn sure they're actually going to get paid. For our $1,000 phone purchase, super simple. Checks all the boxes. We have a contract. Okay, moving on to step 2. Now that we know we have a legit contract, we need to figure out exactly what the company promised to deliver. We can't just look at that $1,000 bundle as one big thing. IFRS 15 forces us to break it down into all its individual pieces. And the official term for these promises, this is a key piece of jargon, is performance obligations. It sounds fancy, but a performance obligation is just a promise to deliver something that's distinct, which basically means the customer could use it or benefit from it all on its own. So let's apply that to our phone bundle. What are the distinct promises here? Well, there are 3 of them. First, there's the actual physical phone. Second, there's the warranty service. And third, you've got that streaming subscription. Each one is its own separate performance obligation. All right, step 3, we've got our promises all lined up. Now we need to figure out the total price for the whole shebang. This sounds obvious, right? But it can get a little tricky when you have things like discounts or rebates or other variables in the mix. The official term for this is the transaction price. And this is the total amount of money the company expects to get for doing everything it promised. And that word expects is really important. It's not just the sticker price. It's what they realistically believe they'll collect. For our smartphone bundle, though, things are nice and simple. The transaction price is that $1,000 you paid at the register. No funny business, no complex variables to worry about. Now, this is where things get really interesting. For step 4, we have to take that $1,000 transaction price and slice it up. We have to divide it among those 3 separate performance obligations we found back in step 2. So we need to put a price tag on the phone, the warranty, and the streaming service. So how do they do that? Well, first you look at what each of those items would cost if you bought them separately. That's their standalone price. If you add those up, it comes to $1,050, which is more than the $1,000 we paid. So there's a $50 discount baked into our bundle. The rule says you have to allocate that discount proportionally. Since the phone is the biggest piece of the value, it gets the biggest piece of the price, landing at $810. You do the same math for the warranty and the streaming service, and you get your final allocated price for each. And here we are, the final step, the moment of truth. We've got our promises, we've got a price for each one. Now we answer the big question. When does the company actually get to recognize that revenue? And the rule is actually pretty simple, but it's powerful. It is all about the transfer of control. A company can only recognize revenue when the customer gets control of the good or service. That's it. That's the guiding light for this whole standard. The moment of transfer is the moment of revenue.
Now, this transfer of control can happen in one of two ways. It can happen at a point in time. Think of buying a cup of coffee. You pay, you get the coffee, control is transferred instantly. Or it can happen over time, like a gym membership or a streaming service where you get the benefit continuously, month after month.
So let's bring it all home for our phone bundle. That $810 allocated to the smartphone, the company recognizes that revenue immediately, at a point in time, the second you walk out the door with that phone. But what about the warranty and the streaming service? That money has to be recognized over time. The company can only book 1/12 of that allocated revenue each month for the next year as they deliver on those ongoing promises.
And it all comes back to this one idea, straight from the standard itself. The whole point is to paint an honest picture, to show that a company is earning its money by linking revenue directly to the value it's actually delivering to customers. So I'll just leave you with this final thought. Now that you get the 5 steps, how does this change the way you look at a company's financial report? Think about a traditional retailer versus a software subscription company. One recognizes most of its revenue at a point in time, the other recognizes it over time. What does that tell you about the predictability and the quality of their earnings? That, right there, is the power of understanding IFRS 15. Thanks for tuning in.